right now with COVID hitting, one of the best things people could do right now is to start looking for homes and stuff like that.
Yeah.
Because the rates are super duper cheap. Lowest I think I've ever seen. I'm not sure.
They're lowest in history, D.
Lowest in history right now, right?
Lowest in
They're
history right
super
now.
low in history, right? So it's like I think right now, like a lot of Black people were talking about, and Latino people talking about home ownership. We talking about buying land and stuff like that. I'm glad that because that's the biggest way we build wealth in our community is owning our homes. Like we all grew up in Queens at some point. We lived in Queens, all of us at some point here and there. And we seen like Jamaica, Queens was one back in the 70s and the 60s and the 80s was the big Black home ownership was in South Jamaica, Queens. Black people own more homes and real estate. Go ahead, Rob. Sorry.
That was the first. Queens was the first suburbs for Black people.
It was the first suburbs for Blacks. Yeah. With that said, like I want to like one topic I think we should talk about is like talking about real estate and how to purchase a home and what's the benefits and some of the pros and some of the cons of buying different kind of things from co-ops and stuff like that. So with that said, our first guest of the night is my dear boy. I know him for a long time. I did business with this gentleman for a long time. He's a good stand-up guy. Can we bring in Kori McManus, please? My man, Kori.
Well, what's up?
Hey, Kori. What's up, brother?
What up, Kori? What up, man?
Nice to meet you.
Hey, I'm good. How you guys doing?
Good, man. This brother cleans up well, man. I tell you, man, this guy come, man, shining on us, man.
Yeah.
You know what I'm saying? He wearing
I put on a sport coat with a t-shirt, man.
You know what I'm saying?
The flower and the flowers.
He coordinating.
Yeah.
You know what I'm saying? Got to coordinate. You know what I mean?
Clean on the show, man. Come on.
You know what I mean?
Yeah.
Something like a pimp.
Yo, like already came in like a pimp. He a California pimp.
There you go.
You know what I mean?
Fresh soda. That's nice. You know what I'm saying?
You
know what I'm saying?
Yeah, nice to meet you, brother.
Yeah, man. So Kori, man, welcome. Thanks for coming on the show, man. We're gonna pick your brain today. Kori, tell the people a little bit about yourself and what you do.
Well, I originate mortgage loans, so I am a loan officer. I've been doing this for 20 years, so almost 20 years. It'll be 19 and a half years, almost 20. And but I originate loans, mortgage loans for those who want to buy a home or for those who are looking to refinance. They already own a home, they want to refinance. And there's some unique scenarios that I've helped persons where, their parent might have grant deeded a home to them. And so they need some financing. So I've guided, gave a structure and guided them what to do to put themselves in a position to get a mortgage loan in that scenario. Because just because you own a home and have a whole lot of equity and you might have great credit doesn't necessarily mean you're going to qualify for a mortgage loan. So there's a lot of nuances into it. And I heard your lead in, Damon, about the rates being historically low. They are low. Mortgage rates tend to do better in a down economy. So this is what you're seeing right now, down economy. So the interest rates are better to entice people to get a mortgage loan and a means to try to stimulate the economy. The unique area that we saw might have been during the Obama administration during his second term, where the economy was starting to recover and they still had low rates. That was a very unique time. But, rates, experts predict that the rates might stay low, maybe through this time next year before we see an uptick. But they're good right now.
That's good.
Yeah. Kori, I got a question for you. Could you explain to the viewers maybe three things? What is refinancing their home for people that own a home? And what is the advantage to home ownership versus renting?
Okay, well, to answer your first question, refinance is when you have a home, whether you own a mortgage against it or let's assume you have a mortgage on your home. And someone might have bought in their home and they had an FHA where they have mortgage insurance on that loan, or they might have put less than 20% down. And there's other mortgages that still have a mortgage insurance. So what we are able to do, maybe a year, 2-3 years down the line, where you're able to get that needed equity in your home, you can qualify for another mortgage to pay off the old one that you have, the current one, whereas it'll lower your interest rate, lower your payment, and get rid of that mortgage insurance altogether, thus giving you a lower payment. So that's a refinance. Basically, you're getting another mortgage to pay off the old one you have, or you're just simply taking some cash out because you don't have a mortgage. So those are a couple scenarios of refinancing. So the benefit to owning versus renting is the tax benefit. The interest that you pay on a mortgage loan, the interest is tax deductible. So that's going to lower the dollar amount that you pay on taxes every year. So whatever you're paying in mortgage, you're gonna lower your tax liability by that amount. So it's tax deductible.
Mm-hmm.
The second part is you get to enjoy that share of equity. So leading into this conversation, I heard Damon say, your family wealth and generational wealth through real estate. There's really only two keys to generational wealth in this country. And that's real estate and life insurance with a period on the end. So that's really just those two. So when it's Damon's time or your time, when it's our time to go, what are we going to leave our family and our loved ones? You leave them your real estate.
Right.
Okay. Or you leave them the cash benefit of that life insurance policy. That's the keys of generational wealth. I was telling a colleague of mine just 60 years ago here in California and in a lot of different counties, it was illegal for Black people to even buy a home. Mm-hmm. You guys are there in New York. There was redlining. It didn't matter how much money you had or how credit you were, how good of a person you were. You just could not buy property in certain areas. It was Blacks couldn't do that.
We had that bad in Long Island. Yeah.
Right, it didn't matter. It was against the law. We could not buy real estate, and so that generational wealth, we got behind in that because our other Americans got a 400-year start on that generational wealth. Right. So, when you buy a home, you get to share that equity. You bought a home today, 20 years from now, let's say you bought a home for $500,000. 20 years from now, it's going to be worth $1.5 million. You can refinance, pay your children's college tuition, pay for their wedding.
You can fix the house up.
You can remodeling. Yeah. And even when you pass away, you give it to your children. Because oftentimes I run into persons who are of retirement age and they're asking me about a 15-year mortgage. And I'm looking at them like, for what?
Yeah.
I mean, what are you going to do when you're 80? You can't do now.
Yeah.
You know what I mean? It's and they don't understand. I'm like, I'll give you the 15 years if that's what you truly want and qualify for it, no problem. But enjoy your retirement. Shrink your payment as low as you can get it, and just enjoy your retirement. Let your kids worry about paying it off.
I'm going to
shrink to pay more.
Exactly. I'm going to shrink my payment so I can have more money to spend in the strip club. I want to be back at the
Exactly.
You know what I'm saying? I want champagne bottles. Exactly. That's what I want. You know what I'm saying?
Hey, yo, I just want
Right.
Hey, listen, I just want to address some things. I saw one or two comments here.
Yeah.
All right. Lisa wants to know, wants clarity. She wants to know what's an FHA. FHA.
Well, an FHA loan
FHA and conventional too.
Well, an FHA loan, let me answer that question. Federal Housing Authority, that's basically an agency loan that's guaranteed by the Federal Housing Authority. That loan typically is for persons who have less than 20% to put down. Okay, so it's a higher risk loan. So an FHA loan, you can get in with as little as 3.5% down. Okay, and there are some down payment assistance programs where they use FHA guidelines, and you can come in with less than 1% down of your own money, and you have a silent second, or just cut. It's what they call a silent second. But the FHA, it serves its purposes in order to help persons get into a home, because the hardest part of buying a home for most people is the down payment. Mm-hmm. That's usually the toughest part, is the down payment. So FHA is a good way to get into a home, less money out of pocket. The challenge sometimes with FHA is it's less money to get in, but because of the mortgage insurance piece, mortgage insurance is what you're going to pay every month on top of your mortgage payment. That kind of tends to put a hitch on the amount that you may otherwise qualify for, but it serves its purpose. Now, you answered, I think, Rodney, you asked the question to conventional. Conventional is another, it's an agency loan, Fannie Mae, Freddie Mac. It's like saying tomato, tomato, it's the same thing. They're two different agencies, but they're basically the same thing. There's some slight differences, but I won't bore you with that stuff. But conventional loans are typically when you put 20% down. There are some conventional loans where you can put less than 20% down. You will have mortgage insurance. Mortgage insurance is slightly less on a conventional loan. Comparing apples to apples, if you qualify for the conventional loan versus FHA, 9 times out of 10, the conventional loan is going to be the way to go. FHA serves its purpose, but FHA is typically for those who really just might not have no other means to get a mortgage loan, so therefore you go to FHA. But if you can qualify conventional, I'll always say go conventional.
Do you the FHA loan is typically an owner occupancy loan. It means you have to
It's
live
always an owner occupancy.
Okay.
Correct. The only exception to that is, let's say you want to buy your parents a home, you can get an FHA loan to buy your parents a home.
Okay.
But they'll look at it a little tighter if you have 3 or 4 different investment properties and you are on paper a real estate investor. It's kind of hard to meet that that guideline requirement of buying a home for your parents, but it can be done.
Yeah.
Okay, I got there's another one. There's a refi question. So let's say you pay on time, you pay on time,
Mm-hmm.
and you have that history, and you want to do a refi. But let's say your income isn't enough. All right. What can you do?
Pray about it. Just kidding. So
Pray a lot.
Well, you know what? You know, when I first met Damon back in 04, you know, I tell people it's harder now to get a loan than it was 10 plus years ago.
Oh yeah.
Okay. So if you would ask me this question before 2008, I'd say as long as you had a 680 credit score, it was done. What you want? Up to $1 million. I didn't verify nothing but your credit score. And so, but that led into the mortgage meltdown we had in 09 and 10. Right? So now you have to meet all phases of the transaction, what we refer to as the 3 C's: credit, collateral, and capacity. Credit is self-explanatory. Collateral is the property itself. Capacity encompasses, will this loan perform in the manner to which it's intended? And that goes to your question about if you don't have enough income. So the challenges here now are, can you get a co-buyer or co-borrower? You know, someone to buy the home with you, or a husband or wife, or someone to help you co-qualify for that loan. Because now, I shouldn't say there aren't any, but you're going to be hard pressed to find a loan where the income piece doesn't matter. Okay, so
That's any kind of loan.
Well, you have hard money loans, which is basically legal loan sharking.
Real estate loan shark. Yeah.
Right. So we
Kori, we might have to explain what hard. A lot of people never heard of hard money loans before. So if anybody might jump.
Well, a hard money loan is it's exactly what it sounds like. Hard money. Basically, you can't qualify for a loan in any other means except to go to, like, you know, remember good times back and say Lenny would come and open and give you all kind of loans and make up. He would make up the guidelines and the terms, right? So a hard money loan is, I'll give you a scenario. Hard money loan is, and I don't originate hard money loans, so I'm going to give you my educated from what I understand about. I'm not an expert in hard money loans. I don't want to make infer that I am. Okay. Right. But a hard money loan is, I'll give you a scenario. Let's say you did a refi, you took some cash out, you got your money, and you want to refund, you're going to remodel your back bedroom. And you knock out a wall, you get going, and then 3/4 of the way through, uh-oh, you run out of money. And so you need some money to finish your project. You can't go to the bank and get a regular mortgage loan to fix that up, because the banks are going to look at that and say, no, finish that first, because we don't want to get caught with a property that needs to get fixed first. Okay. So you might go and get a hard money loan where that particular lender says, okay, you'll sign a deed, he'll put a lien on the property, give you your 30, 40, 50 grand, and give you 6 months to pay it back, and might charge you 25% interest, or 20% interest on his money on a per diem, on a per day. So the longer you go to pay him back his money, he's just making money every single day, whether it's $200-300 a day. And I've seen scenarios like that where builders do flips. They get a hard money loan, and the investor just puts a lien on the property, and that person who got that hard money loan, it's costing them per day $200-300 per day while they're holding this money, fix their project so they can hurry up and sell it, right? And so that's, in a nutshell, I like to tell people, a hard money loan, that's a, like I said, legal loan shark.
Yeah,
It's,
worst case scenario.
What it is.
Let me ask you a question, Kori.
it does serve their purpose when you need it, though.
Yeah.
Let me
the
ask
thing
you. Let
is
me ask you this
that-
question. Oh, I'm sorry. Go ahead, Rod.
No, I was just going to add to that. Basically, those hard money loans, most people use them. They're investors, like you said. They're doing
Mhm.
flips, and
Mhm.
it is risky. The property is under collateral, and they basically use the after repair value of the property
Correct.
to be able to judge if they could give you this loan.
Correct.
The thing is, too, if people that are flipping homes, or they're not experienced or whatever, and you get a
Mhm.
bad contractor, and that contractor doesn't finish that
Oh
work,
man.
you are going to take a beating.
They'll
You're
kill
going
you.
to take a beating.
They'll kill you. They'll kill
Yeah,
you.
you're going to take and they're going to take the property, and whatever work that you
Uh-huh.
started on it, they're going to
Yep.
take it with it.
The
So,
thing-
I mean, go ahead.
No, I was thinking if Kori, if the markets come back, because right now a lot of banks, like credit unions, they'll be the best way sometimes for people to take a little bit of money out. Is credit unions? What's the better part of using a credit union at times if people want to get into homes and stuff like that?
Well, I can't speak because a credit union, banks, they all have their little niches, right?
Mhm.
So I can't speak for all credit unions. I can't speak for all banks, right?
Mhm. Mhm.
So, credit unions typically tend to have fewer options, okay, versus say Chase City or regular bigger banks, or like for myself, I'm a loan officer at New American Funding. The credit unions tend to sometimes, you will usually have less options. They have less type of different loan products available to them. But whatever they do have, they typically tend to exceed at those. Like if they have 2 loans, they're excellent at those 2 because they only do 2, right? So a bank might have 25 loans and they're good at all 25, whereas credit union may only have 2 because they're servicing a little niche. And so they may be excellent at just those 2. But credit union, I think, is your question, are you particularly, are you trying to ask about a line of credit? Is
Line
that
of credit, yeah, line of credit from credit. That's what I messed up on that. Yeah,
I thought so. A home equity line of credit is an institution will give you, it's like having a credit card in your back pocket against the value, the equity that you have in your home. So whatever your value is, take the value, you minus what you owe, okay? That difference is your equity. A lender will give you a line of credit against that equity. So typically the maximum combined loan to value, the percentage is 80%. So if your home is worth $1 million, okay, and you owe 500,000 on your home, okay, 80% of $1 million is 800,000, right? So if you subtract what you owe, it's 500,000. That's 300,000 that's available to you on a line of credit. Some lenders only go up to 100, some 250, some may give you a line of credit to 300. It depends. But the advantages of a line of credit, let's say if you want to buy a home down in North Carolina or Mississippi or Tennessee, we can pick something up for, under 100,000. I would suggest, if you have that equity, get that line of credit, because now you got it in your back pocket and you can go and pay cash. for that home down out of state without having to, because sometimes, who's the gentleman that's just finished a flip?
Rodney just finished.
Rodney. Okay. So Rodney will attest to this. When you do a flip, it's hard to go get traditional financing against that property because that property is 9 times out of 10 is not traditionally available for traditional financing. And that's because the property is what they call distressed.
Correct.
Right? It's either got a hole in the roof or the foundation's messed up or the kitchen's all torn out. It cannot be financed traditionally. So you got to pay cash for that property. What better way to pay cash if you just don't have it sitting in your bank other than getting a line of credit against your own home? You don't pay anything against that line of credit until you use it. So as long as you got a zero balance, you're not paying anything. You get your line of credit, you find something, you tell the seller, I'll write a check for it. Basically just writing a check against on your line of credit, boom. Do what you need to do with that house, flip it. Now the unfortunate thing in the last 5 years, lines of credit, the interest rate, unfortunately, the interest on lines of credit is no longer tax deductible. It sucks, but it's no longer tax deductible. Interest rates are typically, maybe 1 on top of the prime rate, which is, I hadn't even been paying attention to what the prime rate is. Rodney, you might be able to tell me since you just recently done a flip, but you can typically get a line of credit for 5-6% or less, and you're only paying interest only.
Yeah, that's about it.
Let me ask this question:
Does
it make sense to refinance out of one bank into another? Some banks, for instance, during the crisis, I guess in 2008, there were some that banks were going out of business. I think it was one Countrywide and all these different places. They were actually, I guess, flipping papers. But I have this bias against Bank of America. It seems like a very, very hard bank to deal with. But do you need to refinance within your own bank, or can you just go outside of the bank? Does it matter?
No, you can go outside of the bank. Yeah, you can go. So, I actually have done a couple of loans where I've had, whenever you're doing a refinance, when it comes to the operation side and underwriting that file, that loan has to have what is called a benefit to the buyer or to the borrower. Okay, there has to be, I'm fumbling on my word, but there's a term that there has to be a net tangible benefit to the client. Okay, meaning I can't sell you on a loan where you're only going to be saving $35 a month. Okay, because when I get it back to my processing department, they're looking at it, they're going to wonder where's the net tangible benefit for this client to go through this hassle of a refinance. Sure, you're lowering his rate by 0.5 point, but he's only saving $35 a month. Where's the net tangible benefit, right? So I had a client who wanted to refinance simply because she just, and I'm going to put the name out there, but she told me she couldn't stand Sinlar. There was a servicing company, and I got the loan, and I looked at it, and I told her, I said, well, we're not going to meet the net tangible benefit because I'm not saving you enough money. And she said, well, who do I got to write the letter to? I just want to get out from having to deal with them. And so she wrote the letter, and it was accepted by management because to her, this is my tangible benefit. Yes, the rate's only coming down a little bit. I know I'm only saving X amount of dollars per month. I just want to get out from having to deal with that company. And so that was accepted. Okay. But for the most part, when your question is, no, you can get a refinance from whomever, whatever loan, it doesn't matter. You don't have to refinance within the same company that's servicing your loan right now.
Somebody asked a question about Quicken Loans. What are your thoughts on Quicken Loans?
I don't like to get into speaking negatively about anybody.
You might get a job there one day.
Well, it's
I'll
not,
do it.
right. Well,
it might be a sponsor too.
Right, there you go.
Yeah.
See, and it's not just that, but I was taught a long time ago, just as we were kids coming up, if your buddies told you to stay away from this girl and she was cute, we always had to go find out for ourselves. Yep. Right?
Yeah.
So it's just the same thing. If I tell you start speaking negatively about the other lender, about some other company, 9 times out of 10, that client's going to go over there to find out what it is I don't want them to know.
Sure.
Right? So the only thing I can tell people is, look, everything is black and white. I don't hide anything. If I can't answer your question, shame on me. Right? So it's a matter of, I want you to feel comfortable enough and want to do business with me. right? And take interest rate pricing out of the picture. I hope that you want to do business with me. Okay. If you make that decision, I want to do business with Kori, and someone else quotes you something that's slightly better, I'll say, okay, give that to me. I'm going to go to management because I don't want my client to walk across the street over a few dollars. Okay. Because I want that person to say, do you want to do business with me? Right. And if the answer is yes, fantastic. I've done my job. Because I've seen it time and I've seen it where I've had clients come back to me and we start and then someone else shows them something real shiny. Oh, I can get you this. And they want to jump ship. And I've had one or two jump ship only to come back 2 or 3 weeks later because, oh man, they're not answering my call. I can't get any answers. I don't know what's going on. Now they're telling me this and the rates have changed. And
the big banks is like that, Kori. The big banks, it seems like it's hard, like a Wells Fargo. Not talking bad about Wells Fargo, because Wells Fargo, I did business with them before too. But Bank of America, and I agree with you, Kelvin, on Bank of America. But open the business, you take them as a sponsor. But it's not like long time ago we had bad relations. Long time ago.
Long time ago.
Yeah. But do you think like smaller banks like yourself and Rodney and I do business with this lady from Links Mortgage, a lady named Shabana? Do you think those are better ways for people to have? Is a better relationship? Is it things? I know you turn over loans. I know you did. I did this with you before. You said if I can't close a loan in 30 days, I don't need to be in the business.
Yeah. Well, and see, after 2000 and the only thing that's consistent with mortgage lending is change. Okay. It's always changing, always evolving. Okay. I tell people all the time who listen, it's not going to get easier to get a mortgage. Right. Get off that train if you think it's going to get easier, because it's not. Okay. So I learned the business the old fashioned way, and then it got real easy in 02, 03, 04. Right. And then leading up to 08, it was just so simple to get a loan. You can just, we was just passing them out like candy bars, and then it crashed. Right. More than half the people that got into the business after 02 are not in it anymore because they didn't know how to originate mortgage loans the old fashioned way. They didn't know how to calculate debt to income ratios. They didn't know how to analyze a credit report. They didn't know how to look at an appraisal report. So now you have to look at all these things. Your question, Jamon, was, is it better to do business with a bigger bank versus a smaller bank? You can get just as frustrated with a small institution as you can with a big institution. The challenge that I see, that I hear clients, what I hear is clients, when they start this transaction with the loan originator, which would be me, I'm a loan officer, I originate loans. What happens is a lot of loan officers take that loan, and we have assistants, we have processors, they take the application and they throw it over their shoulder. Now you're talking to my assistant or the processor. I don't do business that way. That's just the way I prefer to do it. I prefer my clients speak to me and only me from the beginning all the way through the end, because it makes the communication more direct. Right? You got a question about your loan, you can ask me. I don't want you talking to my processor. I don't want you talking to my assistant, because God, if they can do what I do, they'd be doing what I do. Bottom line, right? I always tell for me, if my assistant can do what I do, she'd be doing what I do.
So Kori, is your job to find a way?
Yeah, it's just, I'm like the pilot, right? We take off, there might be some turbulence, but my goal is to get you to the end and get you there safely.
So if there is a way, Kori, you'll find it.
Yeah, there's a loan there. If there's a loan, I'm gonna get it done.
It's in his best interest to close the deal.
Yeah, because I get paid $0 for not closing a loan.
Correct.
Right? Now, if I can't help you, I'm not going to waste your time. I'm going to tell you probably within the first conversation, I can't help you. Doesn't mean that you cannot be helped, right? Like I said, I don't do hard money loans. If what you need is a hard money loan, I will tell you I can't help you, but you may be able to get a hard money loan, but I can't do it, right? So I hear people, another client, well, what if they're waiting for the prices to come down? They're waiting for the prices to come down on the homes. I'm like, prices aren't coming down.
No, they're not.
They're not going to come down. Now they might, instead of skyrocketing like this, they might
level out
a little bit, but we're not going to see what we saw in 08 and 09.
Yeah. Those are the good old days.
Well, we're not going to see it because we're not going to see it now because everyone who has a mortgage loan has qualified fully for that loan.
Correct.
Their income qualifies, their credit qualifies, the appraisal with what they bought the property meets all the guidelines. Right now we're going through COVID, right? I'm gonna tell you, I won't say the name of this lender, but I had a transaction, and sometimes we can broker out through different banks. Bank has X guidelines. We had a file that met it. We put it into processing. The very next day, they changed their guidelines. They moved the goalpost, right? So we didn't know that until almost a week later when they reviewed it and came back and had suspended the file. I'm like, what's going on? Well, they had a requirement and then they tightened the screws a little bit because of COVID. And I can tell you what the guideline is. It's the amount of reserves. You guys all know what reserves are. So whatever your mortgage payment is, lenders have certain reserve requirements. This lender had 12 months of reserve requirements. My client had more than 12 months reserves, more than 12 months payments in IRA, investment accounts, plenty of money. But what they did was, oh, well, now we need 6 of those 12 months to be in a regular checking or savings account, need to be liquid. So they flipped it. So now it's like, oh, now he's got to come up with liquid cash. So that's what I mean by in COVID, and that was a response to COVID when people are losing their jobs. So the lenders are saying, hey, we want to be more conservative and make clients a little more well qualified and require those reserves to be liquid. That's a direct response to COVID.
Gotcha.
Okay. So and if you work in a certain industry, especially if you work in a restaurant, if you're a restaurant related industry, oh, good luck trying to get a mortgage loan right now.